Hi everyone, Jim here. Bond markets are sending mixed signals and geopolitics adding fuel to the fire. Today we'll connect the dots, yields, investor flows, trade wars, and even the global energy chessboard. If you follow markets, this is where economics meets geopolitics. The bond market pulse. In the US, the yield curve is flattened. 2-year yields keep rising while the 10-year yield hasn't moved as much. That often reflects expectations of tighter credit and slower growth. Companies worldwide are rushing to issue convertible bonds, the most in 5 years. It's a way to borrow while leaving the door open to convert debt to equity later, a sign they want flexibility in uncertain conditions. In Canada, the 10-year government yield sits near 3.2%, and we're seeing a surge in maple-bound issuance by foreign companies. They're drawn by Canada's relatively stable credit market. Geopolitics meets bonds. Geopolitics is now inseparable from how investors read the bond market. Trade tensions. The latest U.S. tariff package on Canadian and Mexican goods adds cost-push inflation pressures that keep central banks wary of cutting rates. China and global supply chains slowing Chinese growth and ongoing tax export controls dampen global's demand for commodities, but also disrupt supply chains, which can fuel price swings. Energy geopolitics. The Middle East remains volatile. Any new flare-up can push oil higher, which often revives inflation fears, and that keeps yields higher. Uncertainty in Europe and Asia is pushing global funds towards North American government and investment-grade bonds, a flight to quality trade that can lower long-term yields and even short-term ones stay high. Signals to the financial community. For portfolio managers, this means positioning is tricky. The bear flattener in the U.S. curve yields tells you markets see tight money now, but weaker growth later. Classic late cycle behavior. Heavy convertible issuance suggests companies want cheap optionality. They can be a bullish equity signal if growth steadies, but it also adds leverage risk. In Canada, the influx of foreign maple bond issuers shows confidence in our market, but also makes us more exposed to global shocks. Central banks. The Fed and the Bank of Canada are stuck between still elevated core inflation and signs of slowing demand. A policy misstep either way could jolt both bond and equity markets. Here's what to keep an eye on in the weeks ahead. North American employment and inflation reports. These will steer expectations for the next rate moves. Any new tariff or sanction announcement that could alter inflation forecasts. Energy price spikes tied to geopolitical tensions. The pace of corporate issuance. If convertibles slow, it may signal credit markets tightening further. Bottom line, the bond market is no longer just about rates. It's a mirror of how investors are weighing geopolitical risks. For anyone in the financial community, from traders to policy watchers, this is the landscape that will shape Q4 positioning. What's your call? Does geopolitics tip us towards lower yields or higher? Share your view in the comments and subscribe if you want regular clear-cut breakdowns that tie markets to global events.